All right, folks. Well, good afternoon. I hope everybody's well. Hope everybody's staying cool. I know we're getting a nice stretch of weather here. It's been a tough one for some folks that don't have air conditioning, but I hope everybody's staying comfortable. I'm excited to talk about some of these topics today. Put this together over the last few days. Obviously, things are pretty fluid out of the US and with some of the economic data. So looking forward to providing my comments. One thing I would ask you is if you have any questions, please feel free to put it in the Q&A box. In addition, I'm going to ask for some help just on future topics. I'll plant the bug right now, but perhaps we can circle back on this later if we remember. If there's any topics or anything specific that you'd like to be either included in the quarterly commentary or on a one-off session like we've done in the past, please type it into the Q&A. And we'll look to try and add that as a future topic. Okay. Perfect. Sorry, guys, as we having a little bit of difficulties here. So today we're going to actually talk a little bit about the economic recap. What should we be considering between now and the end of the year? We will talk about the presidential race and how it could impact markets. Obviously, we have a lot of fresh information since the debate that happened within the last couple of weeks, creating some uncertainty within that overall election process. So we'll chat a little bit about that. And then I'm going to educate a little bit or revisit, why pension plans invest in 5 asset classes, whereas most Canadians only invest in 2. So for a lot of folks on this call, this will be a refresher. Obviously, we've been educating you on this topic for quite some time. But again, it'll be a great opportunity for a refresher of what's happened over the last couple of years. So here we go. So listen, I mentioned this in my the common theme in the last number of these commentaries is interest rates, inflation. And so I'm going to start off this session by giving a little bit of a general recap because we have had some movement from last quarter to this quarter. So inflation and interest rates here in Canada, we'll focus on that first before we move into the US. So in Canada, we are now in between that target range that the Bank of Canada has put out there, which is between 2 to 3%. Inflation now has come in just under 2.9%. As a result, we saw the first rate cut in almost 4 years out of the Bank of Canada, which happened 25 basis points or 0.25%. Looking forward, on the Canadian side, I still think we're going to have maybe 1 or 2 more rate cuts by the end of the year, given everything that's transpiring. I'm going to talk about the labor market here separately. But again, things are softening a little bit on the inflation. There is anticipation for the Bank of Canada to cut again. The U.S. is a little bit of a different story. So inflation has been stickier than expected. It's still at over 3%. And in addition to inflation, they have a hot labor market. Okay. And what's problematic with a really hot labor market is that, if people have more money in their pocket, it keeps the prices elevated. And therefore, central banks have a more difficult time cutting interest rates. Cutting interest rates does the same thing as high job growth, is again, it puts more money in our pocket. So from a Fed point of view, obviously things have cooled a little bit in May, but they're in a holding pattern. They have come out and said they may cut perhaps one time between now and the end of the year. Again, if we go back to the beginning of the year, the expectation coming out of 2023 is that we could have seen as many as upwards of 5 to 6 rate cuts throughout 2024. Currently, the U.S. is looking at 1, and Canada might get 2 to 3 total. So circling back to that labor market in the U.S., it is starting to soften a little bit, okay? So the U.S. employment has started to creep up. We can see on this graph, again, this just goes back over the last 3 decades or so, and we can see various periods of time, 2001, 2002, which was the tech wreck, obviously the great financial crisis in here, and then COVID, we can see we've had significant spikes in unemployment. Whereas if we fast forward in here, which is current, we can see it's been very slow on the uptick, but the benefit is it is actually coming up. Now, that is a good thing for interest rates because, again, as inflation comes down, job growth slows. Again, it gives the central bank or the Fed more opportunity to cut. What's problematic for that is it good for the economy? So we're starting to see some comments. We're starting to hear some chatter about, Could we be on the cusp of a downturn in the market? Could the economy be slowing? Could a recession be on the horizon? I'm not so sure, but all things considered, when unemployment rises, we generally see a slowing or a recessionary times kind of creep ahead. I think we're a ways away from that, but it's something that we have to be mindful of. When we look from a hiring point of view, so not only is there unemployment, people are losing jobs, but when we look at hiring, it continues to slow. Again, job growth is slowing. We can see here as we get through last year and even into this year, things are actually pointed in the right direction. And the last labor a chart that I have is the average hourly earnings are declining as well. So these three areas within the U.S. labor market is actually positive when it comes to interest rates. And again, I think that will dominate the economic outlook for the balance of the year, in addition to that presidential election, which we'll talk about in just 1 second. But again, it sets us up for rate cuts here in the U.S. and in Canada. Now, the one thing I just want to comment about in Canada, even though they've talked about cutting, Bank of Canada cutting 2 to 3 more times or 1 to 2 more times, the one thing between the U.S. and Canada that they like is they try and move their interest rates very similar. So what my concern is if the U.S. inflation number in the labor market doesn't come down as quick as what we anticipate over the next 6 months, I think the Bank of Canada is going to be in a really tough spot to continue to cut as aggressively as what they're hoping. Because what might happen is we might get one more cut in before the U.S. Fed announces their first one. But if for whatever reason the economic data stays sticky down south, then Canada may be forced to actually hang tight on further rate cuts because they don't want to deviate too far away from the U.S. So that's something that we need to keep an eye on. But for all purposes, again, I think we're pointed in the right direction for slowing inflation and rate cuts on the horizon. And here's just a really quick chart. And again, it just shows some large economies: Federal Reserve, European Central Bank, Bank of England, Australia, and Canada. This is just giving you the likelihood of rate cuts between now and the end of the year. We can actually see this is as of yesterday. Bank of Canada, there's that kind of 2 to 3 rate cuts in there. They could surprise us with a 0.5 point deduction. I think they'll come in at 0.25 each time. And then the Federal Reserve, again, there's another 0.5 point. It's possible that they're a little bit more aggressive, does a supersize, rate cut, as opposed to 2.25s. They come in with 0.5 point. But again, I do believe we're just going to see one between now and the end of the year. All right, let's move on to the markets for a little bit here. So another one here for those of you that don't understand what QQQ is versus ABC. QQQ is the ticker symbol for the NASDAQ index. And so what we're seeing, and I've talked about this previously, is that the concentration risk in the S&P 500 and even the NASDAQ, it's actually a lot riskier than what a lot of us realize. Okay. And I've shown this slide before. This is a slide. It's about a 7-year-old or a 7-month-old slide. And what this looks at, it looks at the combined share, the combined weighting of the largest 7 companies on the S&P 500. So if you go back, roughly 4 decades, almost 45 years ago, we can see the top 7, if we look on the left, the top 7 holdings on the S&P 500, which is considered the most broad-based market, most diversified market in the world. We can see that those 7 back in the 80s represented just over 20%, maybe 22, 23%. But over time, when we look at, in the 80s, the 90s, early 2000, and even as we got, 2010 to 2020, those top 7 holdings were maybe around 15%. Okay, notwithstanding here, this was, again, during the tech wreck, the lead up to the tech wreck. Okay, but if we fast forward here in the last few years, the top 7 companies in the S&P 500 as of 7 months ago was just under 30%. Okay, so unfortunately, you take the S&P 500, which is generally, again, the most diversified market in the world, and it's actually quite concentrated on the top end. Now we fast forward to where we are today, 7 months after that, and those top 7 companies now, they actually represent almost a third of the S&P 500. Okay, on the NASDAQ, they're well over 50% of the overall market, but that's to be expected because, again, that's a technology or growth type market. Again, the S&P 500 has technology, has consumer cyclical or consumer staples, all these financials. But again, the top 7 are all tech companies. So not only are they overly weighted on the top end, they're also all in the tech sector, all in the growth sector. So that actually sets us up potentially for some pretty choppy times between now and the end of the year, if for whatever reason, the shine comes off these. And we saw that in 2022, there are a number of these top 7 companies that dropped between 20 to 40% in 2022. So I believe for the balance of the year, diversification will be a common theme in portfolio management across the country. Because again, we can't overweight our clients' portfolios, or Canadians can't, overweight their investment portfolios to just these 7 companies. Because again, if they pull back, they'll see significant declines. Now, here are the stocks this year that are driving the returns. And again, of the 7 companies, the top 7, 6 of them are in it. Okay, the one that wasn't in it was Tesla. Tesla's had a very sluggish year. Up to last week, it was actually down almost 30%. Believe it or not, just last week, it actually moved almost 30%. So it's actually wiped out of all of its year-to-date losses in less than 5 trading days based on the amount of cars they've delivered. So when we look at the overall return of the S&P 500, which as of mid-June last month, so 2 weeks ago, the S&P had gained roughly 14.5%. Only 3.5% of that 14.5 came from the 493 companies that trade. The other roughly 11% came from just these top 7 to 8 companies. Okay, and that's what I mean when we say it's very top heavy. NVIDIA, which has actually been on a tear as of late, it's very it's at all-time highs or close to all-time highs, represents 5%, just that one stock, 5% of the gains of the S&P 500. Again, this is what I'm talking about as being very concentrated. And the reason for this is we're getting obviously that big push with AI, with this innovative wave that we're seeing. But what's happening is we're getting to the point of we're getting a lot of greed and momentum, maybe a little bit too much momentum in some of these names. And if we actually go back, and again, I found this chart very interesting. If we actually go back, when we look at the S&P 500 return, which again is not equal weighted, it's top heavy, as I mentioned. And if we look at the average or the weighted return, meaning if we just took every stock on the S&P 500 and we average weight them, so they all contributed the same amount, the difference between the return on the S&P 500 versus the equal weight return, we haven't seen this disparity unless we go back almost 25 years. So this is the tech wreck. And if you recall, a lot of the tech companies, a lot of these new companies, they were growing at an accelerated pace, okay, to the point where people felt they were missing out. And the difference between the equal weighted return versus the broad S&P 500, the gap was the widest leading into this tech wreck. And here we are 25 years later, and we see something similar. Okay. So again, these differences between these two types of returns being concentrated, we have seen it in the past. Could history repeat itself? It may. We'll have to see. But that being said, this is why I believe diversification will be a key point, again, within Canadian portfolios for the balance of the year, because it might be an opportunity to rotate, take some profits, move them elsewhere to some undervalued companies, perhaps actually increase some of the cash flow within the portfolio. But again, we just have to be mindful of what it could look like if we continue to hang on or jump in late. So I do believe we need to own some of these companies, but we don't want to own them in the same concentrated fashion as what we're seeing in the markets today. All right, let's switch gears into something that's has been really interesting over the last couple of weeks. Let's talk a little bit about the U.S. Election here. So I'm going to go through 2 quick slides that we've seen before for those of you that have joined me in the past. So this just talks about the presidential election when we go back over the last almost 100 years, just volatility and what generally happens as we get closer to that election period. So what generally happens on the volatility point is we tend to see volatility pick up as we get closer to the election. Now, for those of you that actually joined the call last time, one of the things I mentioned is I said, listen, both Trump and Biden have run a country, run the country for a 4-year term. So that some of that uncertainty as we lead into an election, there's a little bit less uncertainty because we kind of know what we get. Well, lo and behold, we have a debate, like I said, recently. Now there's a lot of uncertainty surrounding Biden. the next, I think, couple of days could be quite telling, obviously, with the NATO meetings that are going on. So some of this uncertainty that we didn't think we had, I actually believe we do have more uncertainty today, obviously, than what we did 2 weeks ago, and even almost a quarter ago when we talked about this. So what I would anticipate is that as the election process, as we work through it, I believe we're going to start to see a little bit more volatility in the markets. Okay. And it makes sense twofold. One, again, that uncertainty is number one. Number two, we've actually had a pretty good run this year and even into late last year. And we haven't had really any pullbacks this year, with the exception of April, where we saw a fairly sharp decline in a matter of 3 to 4 weeks. Okay. We've actually had a good May, June into July, tends to soften a little bit. But I would anticipate between now and November, we'll start to see some of that volatility ramp up a little bit. And then when we look at performance, it goes hand in hand with the volatility. So we tend to see markets get a little bit more stagnant as we get closer to the election. The star, by the way, represents, the election, before the election and after the election. So I believe the same thing will happen. I believe the returns may get a little bit less muted between now and the election, and then pick up again thereafter. That being said, for folks that have cash on the sideline or looking to make changes, I don't think you wait, because again, you can be investing in securities that pay you income in the meantime, tax preferred income, or again, you can be picking up some undervalued companies. In general, I still think you can take advantage of what's going to happen in the markets over the next little bit. But again, you just have to make sure we're diversified to manage the risk on the downside and also position property on the upside, so you capture that when it does occur. So let's look at the markets just in general. What happens with markets when one party wins over the other? The reality is, when we go back over the long term, guys, markets go up. Okay, it doesn't matter whether it's a Democrat that gets voted in or a Republican. Yes, there's going to be periods of time where we get contraction in the markets in that 4-year period, but in general, the markets go up regardless of who runs the country. Okay. And whether you like Trump or you don't like Trump, the one good thing that Trump has over, I think, against Biden and his policy is he's very pro-business, which I think will be good for the markets. Obviously, there's a lot of unknowns with the way he manages people and his policies. But again, regardless, they both parties want to see the economy grow. And I think, coming out of 2022, and decelerating or declining interest rates, I think regardless of who runs the country, they're set up to actually have a pretty good term with respect to the growth of the markets. Okay, and here's another one that I thought was interesting. So satisfaction, in comparison to markets. So it's no secret that Americans are largely unimpressed with the leadership that's happening down in the US right now. Okay. And so what I thought was interesting about this is, despite, the lack of satisfaction that Americans have within their political system or with the leadership, markets tend to move forward. And we can see on the right-hand side, regardless, even if it's really low, they tend to see the S&P 500 tends to see, returns generally between 10 to 12%. Okay. So again, regardless, like you said, markets, economies, companies that continue to thrive despite what's going on from a political point of view. And then again, this is just touching base. I talked about this last time. When we look at value versus growth, again, we see significant growth right now. I talked about that earlier in this session. We have some significant growth with those top 7 companies. What we generally start to see outside of, as we come through an election, large cap value type companies start to pick up. They have been extremely underwhelming the last couple of years. They've largely underperformed growth companies. I do believe that we will see large cap value. I believe they will pick up. Small cap value will also pick up as well. So there's a great opportunity because, again, these value companies, they actually pay pretty good dividends. And the reason I like them is because what we're seeing on the interest rates, which is declining, GIC rates, cash rates, and so on are going to be actually declining, month over month, year over year, which means we're going to get less on those assets. And the benefit is these value companies, which are depressed right now, their dividend yields, you can get between 5 to 7% on some of these really large companies, and they're taxed at a better rate, meaning you have more money in your pocket over the long run. So I think we're just at a crossroads right now with the value companies, with interest rates, and it's a really great opportunity to be adding some of these to a portfolio or deploying cash into some of these to complement some of the existing holdings you already have. And then if we just look at the table, again, this goes back over the long run. If we just go to the bottom, I won't go through all of the numbers, but when we look at the average, the large cap growth stocks versus value stocks in every election year over the last, again, 90 years or so, we can see large cap value stocks really outpace growth stocks in general. Again, it might be a little bit different because, again, we're going through this innovative AI robotic type wave, but I do believe, again, large cap value will come around and start to pick up some gains on the upside. Okay. Again, I see a few questions coming in. Feel free to continue to ask those questions. I will circle back to them at the end. All right, let's switch gears. Let's talk about pension style investing, folks. So one of the things I mentioned is most Canadians invest in two asset classes. What's interesting is pension or institutional money, they invest in those two plus more. So generally they invest in 5 to 6 asset classes. Now, you might be saying to me, well, what is an asset class? So we're going to start with a little bit of education for the rationale behind it. And I'm not going to get into extremely deep analysis of these underlying holdings. I'm going to give you some examples, but this would be a great one. If you do have questions, feel free to circle back, send me an email afterwards. Happy to speak about it further. Okay. So generally across the country, here's some of the challenges that investors face. Okay. So number one, retail portfolios consist primarily of stocks and bonds, which are called public securities. These are the two asset classes I mentioned earlier. Okay. And has very limited or no access to private asset securities. So public securities are very volatile. Okay. For a lot of investors, what we've learned over the long run, especially for folks that are in the stage of life where they're drawing on their assets, they want consistent and more predictable returns. Okay. They don't want to see these high highs and low lows, but they want to have consistency, which we've seen in our portfolios over the last couple of years, with 2022 seeing a significant decline in the market. 2023, virtually markets are flat over those two periods. And if you would have owned just the markets, you would have been down 20 to 35%. In 2022, you would have been up significant to be flat. Well, in between there's a lot of restless nights because people panic about, seeing a decline of their net worth of 20 to 30%. So if we can smooth that out, and introduce other asset classes besides just public equities or public securities, the benefit is we've learned people generally sleep better at night. Okay. And then retail portfolios, they lack diversification as they don't typically include alternative asset classes. Again, for the majority of the people on this call, you own alternative asset classes. Okay. And when I go through these, you're going to say, okay, I remember those. Okay. So here's traditional public fixed income. So here's a 3-year chart, guys. Okay. This is 3 years as of yesterday, July 8th. If you actually look at the US and the Canadian bond index, we can see that the overall return, including the investments or the interest you would have received, was negative over the 3 years. In Canada, it would have been down roughly 6%. In the US, it was down roughly 8%. Okay. So if you would have invested $1 3 years ago in a bond investment, you likely would have between $93 and $95 today. On the public equity side, I didn't show the charts, but I showed the volatility. This is the VIX, VIX. It measures volatility. Okay. Now it's interesting. This is COVID right here. This big spike that we see, this volatility spike, this is when COVID happened, when the world shut down. And if you remember, the markets were very volatile. Okay. And when things started to get back to normal, we saw volatility come down. And then it picked up here right before 2021. And again, it continued to come down until we hit the bear market. The first true bear market that we had seen since the great financial crisis, the volatility picked up. Okay. And again, I sometimes get emails, I get calls and people say, hey, holy cow, markets are down a lot this month. And again, we have recency bias because we're looking at it just this month, but we forget that the previous 6 months have been pretty good. Well, coming in 2023 and then into 2024, we can see volatility has continued to soften or reduce. This was April that I mentioned. You can see it's ticked up. And now we're actually at roughly a 4-year low, 5-year low. Okay. Don't worry about the negative 10.6. That just says that the volatility is 10% lower than when we started before. But that being said, this is the lowest period, in the last 5 years. This is why I was saying diversification is going to be likely a recurring theme between now and the end of the year. Okay. As things start to pick up, as uncertainty starts to pick up, the presidential election comes around the corner, we may see this start to pick up in here. And as we get maybe accelerated job losses or what have you, again, the economy might slow down a little bit and we might get some uncertainty. And I don't know if you guys remember, but I showed you that greed, that market, that greed factor, that number. Well, in the years past, we've fluctuated between fear and greed. It's a greed and fear index that we can get off CNN. Well, today it's in neutral. So what investors are saying, well, I don't really know if I should be greedy or if I should be fearful. So I'm right in the middle. Okay. And I think the events over the next couple of months will really determine, the volatility within the markets, and will actually push that fear and greed index one way or another. So what are alternative asset classes? Okay. So again, we have stocks and bonds, public. Alternative asset classes would be anything like private equity, multi-asset investments, real estate, real assets, private credit. Currency could be another asset class. Collectibles, it's not on here, but collectibles, antiques, jewelry. These would be all alternative asset classes that you could invest in as a Canadian to diversify the portfolio. The challenge is when you look at private credit, private real estate, private equity, is that although it's accessible and it's what the institutions are doing at a retail level for people like you and I, it's actually really tough to get into. Less than 1% on average Canadians have access, or they have alternative investments within their portfolio. It's very small. In the US, it's roughly 6 to 7%. So it's not that it's unheard of. It's just a lot of the big banks, they just focus on those two asset classes. Okay. And in Canada, the majority of wealth sits at the banks because that's where most people do their business, is in the top 5 to 6 banks. So the banks are more interested in making money for their shareholders than they are about providing solutions for their investors. So again, they keep it very simple. They generally have at the bank level mutual funds and GICs. Okay. And that's about it. And they tell you to make an RSP contribution and pay down your mortgage. When we start to get out of the big banks, this is where you get access to some of these alternative asset classes like the institutions. And they've done a lot of studies. There's a study, an investment study called Modern Portfolio Theory. And I'm not going to bore you. Okay. But essentially what it is depending on how you hold certain asset classes, you can actually reduce the risk of your investment strategy and increase the returns. Okay. And that's what we look for. Keep in mind, we talk about volatility a lot. And one of the things that we look at within the portfolio is we say, how much risk is our clients, our family taking versus the return they're yielding? Okay. So when you look at the more traditional bonds and stocks, which is this dark line here, okay, if you have 100% bonds, okay, you have a lower return and your volatility is down here. Okay. If you go to 50-50 stocks and bonds, we can see that you drive the return up, but you also drive the risk up. Okay. And then 100% stocks, biggest reward, but also the biggest amount of risk. Okay. Standard deviation. Well, when you start to include alternative asset classes, so these other asset classes outside of stocks and bonds into a portfolio mix, what happens is we can actually drive down the volatility and we can start to increase some of the returns. Okay. And this is an example here, 80% bonds, 20% alternatives. And then as you move up the scale, you look at stocks, bonds, alternatives, stocks and alternatives, and so on. But in all cases, when they've done this testing, is as you add more alternatives to the actual mix and you actually cut out some of the more traditional asset classes, we can reduce risk and improve returns. Okay. So why private? Why would we even want to access private investments? Okay. And so I kind of tongue in cheek here. I said, hey, have you ever heard of IKEA, Lego, Rolex? Guys, these are some of the biggest companies that we are familiar with. They're all private. Okay. 87% of the companies in the US greater than 100 million are private. Okay. So there are a lot of companies out there that actually operate, provide jobs, profitability, so on and so forth, that we cannot buy on a stock exchange. Okay. They just have not gone public. Okay. Yet they are profitable to the tune of IKEA, Lego, and Rolex. A lot of them are extremely profitable and have high EBITDA, which is just, again, the amount of dollars that they put in the pocket at the end of the year. So when we look at the CPP as an example, and again, what I've done here is I've actually highlighted these alternative asset classes. private equity, real estate, infrastructure, private debt, CPP has recognized that private assets is beneficial for everybody here in Canada. So anybody that is actually receiving CPP investments, okay, and the CPP is one of the top pension plans in the world, you own alternative investments. So about 15 years ago, 20 years ago, the CPP, they changed their thinking on how they invest, okay? And if we go back to 2005, the actual percentage of alternative investments within the CPP stood at only just over 4%, okay? But if you fast forward over a very short period of time, over 13 years, they actually drove their private investments or alternative investments from just over 4% to 50%. Now, you might be looking at this and say, Wes, it's 2018. It's a little bit outdated. It's almost 6 years outdated. And if you're thinking that, I wouldn't blame you. So if we fast forward to 2023, again, 1 year ago on their most recent report, again, if we look at their publics, their public equities, their public fixed income only represents roughly a third. Okay, so roughly 2/3 of the CPP are in alternative asset classes. And because of that, they recognize they need, the CPP made a decision, as I said, a number of decades ago to actually include alternatives, because what they needed to do is they needed to drive up returns and reduce the risk. Because at the end of the day, when we went through a 2008 and 9 or a 2022, the CPP managers, they're not going to send a letter out to everybody and say, hey, we've had a really tough year. We're going to reduce the payments we're sending you. They recognize we have more people drawing on this plan than contributing, so they have to have consistent, predictable returns. Okay. So let's look at one of these assets. I'm going to focus on private equity and a little bit on private credit right now. I'm just going to give you a couple of examples. Okay. So one of the things that we can look at in this graph is, if you look at the right side here, some of you have seen this before. These are the equity markets: Canadian equity, US, global, emerging markets. Well, what we see here is that the average return over this time period has roughly been double digits, regardless of what you invest in. Okay. As you go down the scale from Canadian equities to emerging markets, the risk increases. So there's more of an opportunity to hit a home run in emerging markets, but there's also the opportunity to lose more as well. Okay. So the greater the risk, the greater return, and that's why you get the better average overall. But what we recognize is, if we just include these fixed income or equity markets, we're going to suffer this for our families. Well, if you look on this left-hand side, this is real estate. These are different sectors of the real estate market. There's commercial, industrial, office, retail, and then there's multi-residential. Okay. Now, regardless of which one you look at, the average rate of return has roughly been double digits, just short of it. So very similar to equity markets. But what's interesting, and we like the multi-residential properties more. So apartment buildings, student housing, storage facilities, and so on. Ones that provide income, all right? These have been the most predictable and stable sector within the real estate market. So if we look at this, the highs aren't as high as the equity markets, but neither are the lows. So again, very consistent, very predictable. And so this is why, for a lot of folks that are on this call, we own some in private real estate, not public, in private. Okay, and I'm going to explain the benefits of that in a sec. So again, it's prudent to be looking at things saying, hey, should we invest in just stocks and bonds? Or should we be open-minded to some of these other asset classes? Should everybody invest in these? They should consider them. And in most cases, they should be included within an efficient portfolio. But again, it's situational. So some people might say, no, I don't want to invest in these. I want to invest in 100% equities. No problem. But I think having the ability, the opportunity to invest in these different asset classes are a game changer versus what's generally out there in the industry. So let's look at this for a sec. So traditional public real estate. Okay, so for most Canadians, if they want to add real estate, they either go out and buy a rental property and become a landlord, which is really expensive with high interest rates, or they buy a REIT. Okay, so what they do is, there's a REIT in Langley. I'll use it as an example. There's a company, RioCan. It's a company that trades on the TSX. They have multiple properties across the country, and it's a publicly traded stock. Okay, it would have been part of the Canadian REIT index. Well, if we go over the last 3 years, okay, traditional public real estate, just like fixed income, if you put $1 in, you would be negative over a 3-year period. You would not have made a one profit in 3 years if you had invested in REITs back in 2021. And it makes sense. First of all, coming out of COVID, they dropped 40 to 50%, not because the value of their companies or value of their real estate went down, but rather the uncertainty. People traded them. They trade on an open market. And then if you look here, in 2020 to mid-2022, interest rates really started to decline, and these are interest rate sensitive. So we've seen a decline on them. Okay. So again, owning real estate the traditional way would have led to a 3-year loss. Okay. Now here's a couple of private REITs. Okay. This one is a Canadian REIT. It's private. It doesn't trade on the market. It has 152 properties, 21,000 rental units. It's actually over 22,000 rental units, mostly in Canada, a little bit in the US. Okay. This investment has yielded double-digit returns. It hasn't had the same volatility as publicly traded REITs. Okay. This is just one example, guys. Here's another one. This is another one out of Ontario. This is an apartment REIT. It's in 7 provinces, 244 properties. 95% is occupied. Again, double-digit returns. So just out of this investment and this investment, there's 400 properties that your money is diversified in. Okay. So the challenge of investing in these directly is obviously you have counterparty risk. You're invested in one, number one. Number two, the challenge is that a lot of these might have liquidity constraints. Maybe you can only get your money out once a year, maybe every 6 months, maybe every quarter. So there's some challenges with them. Okay. But they're out there. People could invest in them. All right. This is private credit, guys. So I'm just going to talk a little bit about private credit. So public credit, maybe TD Bank issues a bond, you put it in your portfolio, you get paid a percentage, 5%, but then that bond trades up and down. Okay. And it can be worth more, it can be worth less. Well, this is a private lending, alternative lending. And we can see that despite 2000, the bursting of .com, Enron, subprime, COVID, the blue line, this is their performance. It's been roughly 9% over the last 20 plus years. Okay. Now, again, I'm not suggesting everybody runs out and buys these three investments. The problem is you might need a lot of money to get into these 3 investments because they have minimums as well. Okay. But the purpose of these 3 isn't to say go out and do them, but rather educating you that these are the types of investments that we have access to that a lot of you on this call have in your portfolio today. Okay. So again, why aren't these things accessible from a retail level? Again, I mentioned liquidity, lack of accessibility. So again, for some institutions, they don't want, the banks are going to do the due diligence, to have their investors, move away from their profitable mutual funds at the bank to go into these types of investments. Okay. For a lot of these as well, you need to be accredited. You have to have a certain net worth or maybe an income to get into them. And these are all problematic. So we recognize endowment funds like Yale, Harvard, the big pension plans, CPP, Ontario Teacher Pension, they use these types of asset classes. So why shouldn't we be able to do it? So Harbourfront recognized that issue a number of years ago, and we were the very first financial institution in Canada to offer a multi-manager, multi-strategy type alternative pool for retail clients. Okay. Now, what's interesting is we actually felt that when we came up with this, these accessible vehicles or access vehicles, we actually thought, when we came up with them, we would actually see a lot of the industry kind of come to market with them. And we have seen it, but it's been very slow. Okay. It's been very slow. We get folks that call us, other institutions that will call us and say, hey, you guys have been the leader here. How are you guys doing it? Tell us what your process is. And obviously we don't give it away because again, it's something that we actually hold very dear for our clients. So again, we have 30-day liquidity with our private credit, private real estate. We also have a private equity pool that some here have been invested in. It reduces counterparty risk by the way it's structured because again, there's roughly between those 3 holdings, 40 sub-advisors. The benefit there, again, the money gets split into a number of different ways. Nobody on this call could likely go out and buy 40 different sub-advisors or investments just in this space. You would likely need to have probably close to, $4 million, $2 to $4 million just to get a proper diversification of those 40 investments. Okay. We get access to closed investments. And the beauty is, again, it's accessible to all Harbourfront clients. We're here we're portfolio managers. We have the ability to educate our clients. And if it's suitable, we can actually suggest, adding these to the portfolio. So let me just give you two examples. I go back to the traditional public fixed income. Again, I've talked about the return on this over the last 3 years. If you were to go and buy a bond or the bond index, again, you would have made no money. If you look at our private credit pool, which is our Rockridge private debt pool, over that same period of time over the last 3 years, it's yielded just short of or just over 20%. So a little bit better than 6.5% per year. Okay. Our pool targets between 6 to 7%. I actually think it'll actually increase as we actually move through this interest rate environment, because a lot of the lending is actually being lent at higher rates. And I know some people on this phone might say, hey, you know what? Are they safe? Are they good underlying customers that are taking these loans out? I'm going to give you a very personal example. I'm going to talk about my mother-in-law. My mother-in-law, she downsized her home. Some of you have heard this story. She downsized the home. My father-in-law passed away. She lived in that home for a couple of years, and then she downsized to a condo. And during that period of time, she needed bridge financing. She sold the house, but she bought the condo, which was going to close before the house. But the problem with our Canadian financial institutions today is that they qualify people on a mortgage or on a loan on two factors: your income and your assets. Well, we knew she had the assets, but she lived on a limited pension. She didn't need a lot. She had low income, and they declined her. Bank of Nova Scotia would not give her a loan. Okay. So she had to go to an alternative lender for a short period of time to actually bridge that loan in order to actually close on the condo until her home closed, which already had a sale pending. Okay. So there is an example of individuals needing some of this alternative lending within Canada. Okay. And I probably have 2 to 3 to 4 more stories like that of clients, of business owners that have had to do the same thing, where big Canadian financial institutions will not qualify them or will not give them a traditional line of credit because, whether their assets or income, they can't take that on paper. Okay. Number 2, traditional public real estate. I showed this earlier. Last 3 years, we would actually have a negative number. Well, if you look at our Foresight private real estate portfolio, okay, which is a combination, I think, of about 15 sub-advisors. That's where, the 2 private real estate investments that I showed earlier would be part of this. It's averaged just under 8% over the last 3 years. Okay. And again, the reason why you're going to say, hey, why doesn't it fluctuate like a market does? The reason why is it gets valued at the end of every month. So we can actually see it's very predictable. Here's where we had some flat growth in here, and then it picked up and it's been growing ever since. It's only in almost it's 5 years. It's posted 1 negative month in 60 months. Okay. Which is incredible. It's never had a negative quarter. So again, here's a private real estate portfolio versus public, and the outcome is much different. So if you go back to that graph I talked about, that modern portfolio theory, here's the reason why we can drive down the volatility, drive down the risk, okay, and still keep strong returns, because again, we're adding these types of investments. Okay. And I think this is really important right now, folks. And I would be remiss not to mention it. The S&P 500, it's at all-time highs right now. We're seeing very rich valuations. We're seeing job losses pick up, which again is good for interest rates, but maybe a little bit tough for the economy. We have uncertainty as we head into the presidential election. And I'm not saying this to make people nervous. I'm just saying we're planning for this. We're preparing for this. We recognize there's going to be potential volatility. So we're not waiting to react when it happens. We've already been positioning the portfolio in anticipation of some of this ups and downs. And we know it works because we saw 2022 and we actually predicted a lot of our clients' growth over the last number of years, and we held onto their net worth beautifully. So I believe, again, we're positioned well. But for others that are on this call that maybe don't have access to this or they haven't looked at it, my suggestion would be drop me an email or give me a call. We can talk about it a little bit further. Okay. All right, guys, that was my last piece. I have some questions that I'm going to go through. I appreciate you guys hanging in there. It's a beautiful day today. Hang tight. Like I said, I'll walk through these questions. I know these are valuable. A lot of people I find this a useful part of the session. The other thing, folks, I mentioned it earlier, please put in that Q&A section any topics you'd like for next sessions or a one-off session. It could be mortgage rates. It could be, should I renew? It could be cash flow management and retirement. Will I run out of money? There's a lot of different topics. type it in there and I'll try and work it into my future sessions. Okay. So somebody asked here, jobs in the product COVID numbers you see. Oh yeah. So actually I see here somebody's asked, with jobs in down south, Silicon Valley, down to prior COVID numbers, in other words, there's been job loss. Do we see that as foreshadowing for these 7 companies failing or falling, or is it due to the use of AI that tech companies need less workers? That's a great question. I think there's a little bit twofold. And, I'm going to use an example of when Elon Musk bought Twitter. Okay. So I don't know if you guys recall, but when Elon Musk closed out on Twitter, now it's called X, he actually let go a significant amount of staff. Okay. And a lot of people thought he was crazy. But the reality is when markets are doing well, when the economies are doing well, companies hire. And what happens is they hire because they're trying to be more productive. But what ends up happening is they become even less efficient, because now what you have is you still have your core workers. You could have the top 20 to 30 to 40% of your core workers doing the majority of your work. And then you could have, these fringe workers, I don't know what the percentage is, but again, they're not contributing as much as those other workers. So I think in most organizations, you could actually probably trim, a good portion of those workers and still be profitable. As a matter of fact, that's how companies become more profitable, more lean, is by eliminating one of the biggest expenses, which is labor. Okay. Number 2, yes, AI is making some of these jobs redundant, and we're going to likely see that as we move forward. There still is a human element that I think we need, but as we go through this innovative wave, I think, we're going to see more and more of these AI thinking, AI programs that will replace some of the jobs that are out there. What I think is a little bit problematic with AI, and again, this is just my opinion, I think it's very loosely regulated right now. I think some of the really big companies that are in the game, people like Microsoft and so on, they're large enough to help regulate it, to be mindful of it. We have a lot of small companies that are coming in, okay, dipping their toe in the AI kind of sector, and they might not have as many tight regulations in terms of how AI works. And so again, if they come out and they regulate it, which I think they'll have to somehow, we could actually see AI slow a little bit, or maybe just to have a pause a little bit. But I do believe we're going to see it in the near future, and it will affect employment in the long run. I think, again, it's twofold. Okay. Okay. So actually, somebody else just has a question here about the presidential election. They said, hey, what are my thoughts on the whole Biden situation? I did mention it earlier. I think from an economic point of view, if for whatever reason he steps down, the markets, I don't believe will like it. I mean, maybe in the short term, I think maybe there might be some optimism because we're going to get some new leadership, but then I think it'll quickly turn to uncertainty. But that being said, once we work through that, and again, I think the foundation for the economy, I think, is pointed in the right direction with interest rates coming down, inflation coming down. I think we'll get through that noise and we'll get to that next step up. But during that period of uncertainty, we could see a little bit of choppiness. So I do believe in the next couple of days will be critical. I know he's come out and said that he's steadfast. He's going to be staying in for the long run. But I think that the greater party could win out if it gets to that point. So we're going to have to see. It'll be a very interesting time over the next little bit. I don't believe it'll get to November before they make a change. Obviously, they're going to have to make it sooner than later. So if they do have a new candidate, they can wrap their head around it and get them properly positioned, if the Democrats want to hold the House. But we'll see what happens. So yeah, definitely keep an eye on it. But if you start seeing some volatility in the portfolios for people that are here, again, just know that we're familiar with it. We're expecting it potentially, and we plan for it. So again, if you have questions, feel free to drop a line, send us an email or what have you, and we can chat further. So, okay. I think that's all we have. We only had a couple questions today, which is great. I think everybody wants to get out and enjoy the sunshine or sit in front of the AC. Again, if anybody has any questions, comments, drop us a line. I really appreciate you joining us today. I hope everybody has a great summer. Stay safe. And again, if anybody needs anything, please reach out. Take care. We'll talk to you everybody soon until the next one. Thanks, guys.